Welcome to Money Watch Weekly. I'm your host, Yowela Chomba. Now, the quarter comes to an end this week, during which Zambia has been through a major transformation politically. Nothing significant has happened economically yet, or we'll find out. But with the new leadership, and especially the transition having been peaceful, there's a positive sentiment and optimism around the country's future. Now, that said, we take a look at what has been of the quarter economically, and also take a focus for the last quarter of 2021. To help us do that, we have Mr. Dean Onyambu, economist and fixed income and currency strategist at Standard Bank Group here within Lusaka. Welcome to Spring 24 TV, Dean, and welcome to Money Watch.
Thanks, Yowela.
So it's a pleasure to have you. I haven't seen you in a long time.
Yeah.
Yeah, you've become more like a quarterly appearance, which is good.
Exclusivity.
Yeah, that's good. Now, Dean, let's get into it. The quarter has gone by real quick, and with it, a lot has happened, albeit significant. Now, notwithstanding the major political highlights that we've experienced during the period, can you give us a generic economic performance of the past one quarter with a focus on FX, inflation, the PMI that you guys government securities? Just give us an overview of how we've transitioned through the quarter on that perspective.
Okay, so if we look at the FX, I think fundamentally a lot of things have changed. Yeah. We are moving from a place where our dollar savings in terms of the international reserves, at the end of March, we were really only at around $1.2 billion, which only covers imports. So that's an import cover ratio of 2.1 months. At the end of August, $2.9 billion in terms of the FX reserves, which is up to 5.4 months of import cover. Yeah. That was significantly higher because of the SDR allocations, which went to everyone. We got 1.3 billion. But you also had significant offshore investments coming into our government bonds. And that's the main reason why you've seen those yields coming down. In terms of where your foreign portfolio holdings are now, increased from around $869 million at the end of December last year. Those are up to $1.9 billion at the end of June. So that's an increase of $1 billion. Potentially even higher at the end of July to around $2.3 to $2.6 billion. Yeah. So that has really underlined the significant increase in FX reserves, as well as, obviously the mining dollars coming through from the mining sector in terms of what's going to the central bank. On average, if you look at the fortnightly from the central bank, between January and June, they were getting around $160 million per month from the mining sector. In terms of growth, I think we're a little bit more optimistic. So, as you all know, over the last, I'd say 6 years or so, if you look at the PMI, your long-run series average has been around 48.3. So your private sector has largely been in contraction, and it's mostly been a function of fiscal performance in terms of the government's accumulation of arrears to the private sector, as well as the fact that they had been borrowing aggressively from the domestic market, which meant that interest rates were elevated for a long period of time, which is that overcrowding effect. You've seen some of that pressure being alleviated. And if you look at the PMI over the last 6 months or so, you've seen that the PMI, in terms of the print, has been above that 48.3 long-run average. Yeah. So your private sector is nearing stabilization. Optimism is coming through your business output, your new orders as well. You've seen new orders now responding to increased customer demand. Going forward, you'd expect that, given the fact that you've seen the kwacha appreciating, it takes some time for businesses to run out their stock. Once businesses have run out their stock, I think there'll be an opportunity for consumer prices to be adjusted lower. And that's going to underpin a further recovery in your consumer demand. And we think that does bode well for growth. In fact, while the government's looking at GDP growth at around 1.6% year on year, central bank's also looking at around 1.6%. We think that GDP growth this year will actually be around 2.3% year on year. In terms of interest rates, the larger driver of interest rates in the longer end, your bonds, has been that improved participation from your offshore investors. That's underlined that move from 33% to 36% in terms of the yields. And now we're somewhere between, if you're looking at the secondary market, really, you're somewhere between 18% to 27%. And that's, pretty much it in a nutshell.
Right. Now, in terms of securities, I don't know if you've mentioned, how has the government performed, the economy performed? Well, I would say, how have securities performed in the period? We saw an upswing, an oversubscription just after the change of the transition into the new administration. But again, that reduced to about 6 billion. Tell us more about that.
Well, I mean, it's all linking to that increased offshore demand that I'd mentioned.
Yeah.
I know significant moves happened after the election, but like I mentioned to you, you had already seen significant offshore interest ahead of the elections.
Okay.
You had actually seen that foreign ownership of government securities increasing from $869 million at the end of last year to $1.9 billion. So already that move higher by $1 billion had already happened ahead of the elections. And then obviously after the elections, you had improved sentiment, adding to a further interest coming through from offshore players. But I would say, given where we estimate that we are, the large majority of these investments actually manifested ahead of the elections and not after the elections.
Right.
After the elections, I guess what you did see was a desperation with regards to those who were late to the party, bidding aggressively lower so that they don't miss the chance to actually get some yield on the books.
Interesting. Now, I did mention that the economy had a very significant shift politically.
Yeah.
How important, what sort of impact did that shift have on the economy, especially with how we relate with our bilateral partners?
Well, I mean, it's not a difficult question to answer, Yowela. I think the main impact here is with regards to addressing the credibility deficit.
Yeah.
I think one thing that came up in the conversations with regards to the government as well as external creditors, particularly when you look at the Eurobond holders, was a concern with regards to credibility, particularly with regards to the size of the total size of the external debt.
Yeah.
I think what has been positive in terms of the discussions there, but negative in terms of the balance sheet of the government or of the country is the fact that we now understand that the external debt could actually be a lot higher than was previously disclosed. For me, it is a bit concerning because you've already seen that your external debt arrears, because we have been in default for a while, those have increased to around $1.5 billion at the end of June this year.
Yeah.
If we consider also the government's guarantees and their contingent liabilities, at the end of last year, those were $3.27 billion. And a large majority of that was for ZESCO, especially on the back of the Kafue Gorge law. If we also take the government's external debt stock, which is now at $12.9 billion, then your external debt, taking into account that debt stock, taking into account government guarantees and contingent liabilities, taking into account the arrears, could actually be at least $17.66 billion. That's already 102.8% of GDP. So, yes, there's a positive shift with regards to addressing the credibility deficit, but the size of the debt could mean that maybe the debt restructuring conversations could be a lot slower than we anticipate.
Yeah.
And for me, that's where the real concern is. We still expect an IMF program by the first quarter. That's under our core scenario, which we attach around a 50% probability to. And, debt restructuring for potentially some of the commercial debt like the Eurobonds could happen quicker after an IMF program, but it might take a little bit longer to actually restructure the entire debt stock. And I think maybe the current assumption within a lot of the market is that debt restructuring, all of it will be concluded immediately after an IMF program is done. I think we might need to take a little bit more of a pause there to think about that. Under a bull scenario, if things go better than we've actually anticipated in our core scenario, we're looking at an IMF program by the end of this year.
Yeah.
But from where we stand, the budget is going to be key to that. We get the budget at the end of October. So if you look at the early indications, is we might not see a significant reduction in government expenditure, maybe just a reallocation to priority lines like your health as well as your education, so your social spending. And, if that's the case, then it puts pressure on the government to be able to raise resources.
Yeah.
They've been talking about tax reforms. Are we going to see, for example, a reduction in pay-as-you-earn? if we do see tax reforms in that directions, pay-as-you-earn going down means less domestic tax collections for the government. This year, domestic tax collections have been strong, but they've also been pushed up by extraordinary revenues from the central bank dividend, for example, based on the effect of the depreciation of the kwacha on FX reserves in 2019. That's not likely to happen next year, especially given the fact you've seen the kwacha appreciate.
Of course,
So you could have a bit of pressure to actually sustain that strong domestic revenue tax collection. And if you're the other side, you're not going to reduce expenditure, and you're going to actually implement a pay-as-you-earn tax cut, for example, then you might need to raise revenues in another area. The governments, before they came into office, the manifesto spoke about consumption taxes. So for me, I wonder whether you're going to see VAT higher or even some excise duties to try and compensate for the slight downward pressure in revenues. So I mean, that's going to be the interesting thing going forward, because I think they'd have to do that for them to really fiscally consolidate. Because we talk about fiscal consolidation. You can do it in one way. You either reduce your expenditure or you significantly boost your revenues, because what you're trying to reduce is your budget deficit. For us, our budget deficit was at 12.9% of GDP last year. Obviously, that was pandemic driven. But also, spending. It was also spending 1 year ahead of the election. This year, the target was around 8%. Given the strong domestic revenue collections, maybe it could come between 6% and 6.5%. But in those conversations with the IMF, I'd expect that trajectory for the budget deficit would be to come under 5% and maybe even come to a place in about 3 to 5 years
over time.
Where it's a budget surplus.
I like the fact you mentioned the IMF, and I'd like you to just clarify a few things. The president just returned from attending a week-long trip to the US, where he was attending the 76th session of the UN General Assembly. And while there, he took advantage of a potential visit to the World Bank and to the IMF. He met both Bretton Woods institutions. Now, how critical? We don't know what the discussions were like. So I would assume, or we would assume, that it's in line with us having been quoting the IMF over the past 2 to 3 years for a bailout package. Now, how critical are these meetings? And with him being back, and now the IMF as an IMF team in the country for the 1 week meeting the Ministry of Finance, why would you anticipate a bailout in Q1 2022? Can it come earlier? And also, there are sections of society that feel we don't need the IMF because they'll just take us into a worse off position. Maybe just clarify the importance, because personally I know it's important to get that under the way, and then it just helps with other discussions with people who owe money. But just take us through, what do you think came out of the World Bank and IMF meetings?
Okay. I'll speak about the second question first. Do I think personally Zambia can do without an IMF program? I think there are ways that it can happen, but it's going to be very, very, very difficult. The reason why an IMF program is critical for us at the moment is we need to be in a position where we can, number one, have an endorsement that we are taking on a policy that's going to address our fiscal. The IMF does that for us in such a manner that it helps us to address the critical deficit that we had over the last 2 to 3 years in external financing. Because not only will we get financing from the IMF for balance of payment support, we'll also be in a position where we can now also attract or be able to get some foreign capital. Because
they get confidence that the IMF is managing
it's all
this
about
process.
Confidence. You need a rubber stamp of confidence. When I speak about that credibility deficit, yes, some of it has been addressed. You've seen that positive sentiment, giving that sort of direction in terms of the thinking. But it takes a long period of time to fully address a credibility deficit that has been eroded over a period of time. It doesn't come immediately. So while, yes, naturally we can actually implement a budget that consolidates fiscally, we still need somebody to rubber stamp that for the external viewpoint, and that's an IMF program. Not only that, I think also an IMF program, also with regards to decent policy coming through from the government, also has the potential to reverse the direction of foreign direct investments. Foreign direct investments, which is your longer-term sustainable investment into specific sectors, has actually been declining from around $1.2 billion 2015, 2016 to only about $100 million last year. And we've got decent sectors, which we can speak about later, your mining, your manufacturing, your agriculture, as well as your electricity, that have the potential to really underline strong growth for this economy if we do things right. The reason why that external financing is so important for us and why that IMF leads to that is because it will put the government in a position to not rely on this domestic market for borrowing. And that, for me and you, the benefit is going to be that your interest rates start to come lower. Because the biggest reason your interest rates have been elevated for a long period of time...
Because we're competing against government.
Exactly. You're competing against government. And you know two things from your economics basics lesson. Number one, your government has a larger balance sheet.
Of course.
Which means that it's a lower risk for the financial sector to lend to the government. On top of that, if the government was accumulating arrears to the private sector, your private sector companies who were relying on the government to pay them back, their contractors and suppliers, and they didn't have money to be able to pay back their credit and their loans into the financial sector or from the financial sector. So I mean that impact had a ripple effect downwards with regards to the comfortability of the financial sector actually extending loans to the larger economy. Yeah,
interesting. So we do need an IMF package, and of course, one day the government, I know they are preaching transparency, so they will tell us what was discussed in those meetings. But moving on, and I like the fact
as well, Yowela, just to add, I think what's going to be important is not just what they discussed. We are finally going to know what the size of the external debt is. On top of that, we will have a greater appreciation of what the domestic debt is, not domestic debt, government securities. Those, they're published regularly. But we're talking about your domestic arrears. You're talking about your VAT refund arrears, your arrears to the fuel sector, your arrears to suppliers and contractors. We will finally get a full appreciation of what we actually owe. And I'm hopeful we'll get a direction into how the government will go about dismantling some of these things.
Interesting. I like the fact that you mentioned some of the FDI that potentially can come to the country is where they pump money in different sectors. Now, with the dawn of the new government, it's brought about setting up of new ministries. Ministry of SMEs, the green economy and technology and science. Now, how timely are these creations, if I may put it that way, in terms of dealing with issues? As much as we want to be Zambia-centric, how important are they, and how do we relate to all these ministries being set up at a global level?
Well, I mean, I'm positive in the sense that it's in line with the trends that you're seeing in the global environment, particularly in line to your SDG goals. But for me, I'm a conservative thinker, and I'd like to believe that it's going to take some time. Yes, I think the government's in a position to be able to build this economy in a way to drive growth for the next 20 to 30 years. Almost similar to what happened in multi-party in 1991. The SME one is important because I think while your cost of capital is moving in the right trajectory in the sense that we're moving into an environment where interest rates are low, it's access to capital that I think we really need to look at as an economy. We need to look at what sort of collateral can actually be acceptable within the financial sector and what sort of regulation from the government side can actually improve to enable SMEs, as well as you and me, your households, to be able to move in an innovative direction, but with ability to actually access capital. And for that to happen, the type of collateral that is acceptable in the financial sector needs to change. Because you want a young person who's 21 years old, he's got an idea.
Very good business idea.
Very good business idea.
They have no collateral, at least the conventional collateral.
Exactly.
No house, no whatever.
No house, he doesn't have a conventional collateral. Even worse, you say, okay, fine, let's accept land. 21-year-old does not have land.
And of course not.
Doesn't have a car. So what sort of collateral is he going to be able to give to actually get a loan from the financial sector? It's basically impossible. For me, I have a concern that some of the metrics that we have to actually model our risk profile for the youth and for younger businesses and innovative ideas, which are not necessarily the conventional ideas that you're already seeing there, are not future-centric. It's still linked on your old metric system in terms of valuation.
So that needs to change.
That needs to change, and I think that needs to also be driven from this new Ministry of SMEs. In terms of technology, of course, the world is moving into a space where technology will be greater leverage to actually drive economic growth. But do we have the expertise locally? It needs to be backed by education. We need to build the expertise locally for us to actually have those people growing into be able to provide the labor for that sector. But also just with regards to technology, one thing that we don't normally speak about is that when you move deeper into automation, you actually need less labor.
Of course.
In other economies, particularly where you can actually, I won't speak about the country specifically, but you can have that mining sector in a specific African country that can be driven by technology. There has been a significant amount of pushback into moving in that direction, because where are you going to take the labor that's going to be replaced by that automation? So as we move into that, I think we must also be conservative to understand that the automation or the technology that we drive is going to have an impact on labor, and we need to find something for those. In terms of the green economy, I think that's something in line with your SDGs as well. And given what we're looking at, low carbon, using your natural capital and your natural resources as an economic capital, you have to protect it. I think that's positive, particularly if I look at a sector like your electricity generation or your power generation. I look at Kenya, I look at the Lake Turkana wind power project that actually increased their output in terms of electricity generation by 17%. Do we have potential there? It's significant. According to the ZDA, right, Zambia has 40% of the water resources within the SADC region. On top of that, we've got potential to increase our hydro from right now after the Kafio Gorge, maybe around 3,800 megawatts to around 6,000 megawatts. Potential is there. World Bank also says Zambia is one of the countries with high solar potential. So if you address specific regulation in that sector, right? For example, something like protecting the transmission lines of private sector companies. That's another sector linked to the green economy in terms of maybe scaling up solar generation, hydro generation, potentially even wind generation, that has significant capability of attracting foreign direct investment.
As we wind up, Dean, we've taken a quick look at what Q3 was. Now let's go forward into Q4. And from your standpoint, what is your take or outlook on Q4 as we head into the end of the year with regards to balance of payments, FX, fiscal policy? We have a new governor, Denny Kaila is back. So in your analysis, what should we expect in Q4 as we end the year? And also, I'd like you to mention your expectations on the budget, because honestly, I won't have you until way after the budget back on this.
Well, I mean, the budget is something that we already covered. I'd like to see what amount of goodwill we get. For me, if we maintain a budget deficit there of around 6% to 6.5%, which is maybe where we could end up this year, given the outrun to July, then it suggests we've got a lot of goodwill out there. Because that would mean that you might see a reduction in things like maybe pay as you earn taxes without necessarily seeing a compensating increment in things like VAT. In terms of growth, we're looking at growth being 2.3% year on year. As I mentioned, you're looking at the reduced amount of the dollar kwacha rate. It will start to play a part in terms of consumer prices coming down. That should now enable us to afford a lot more goods out there. You've already seen, with regards to your trade data, importation has been going up for a while. Now you've also seen consumer goods imports That is now above pre-pandemic levels. It does bode well. But something that we've forgotten about has been cost reflectiveness. Are we still going to see fuel pump prices being adjusted higher? Last time that happened was December 2019. Given where the dollar kwacha price is now and where the Brent crude oil suggests that we could see those being adjusted 35%, maybe higher. North of 35% higher. Electricity, according to ARB, Zambia's electricity price at the end of last year was 65% cheaper than the SADC region.
True.
Are we going to see movement there? Is it still going to be difficult to increase electricity tariffs for the mining sector, which consumes 50%?
Yeah.
If it is, it means the rest of us have to bear the brunt of this. We'll feel, so if electricity is adjusted 65%, maybe double of that because of what mines consume.
Yeah.
How is that going to happen? 2019, it was staggered, it was staged. Are we going to see that coming? If it does, it will impede the recovery in consumer demand.
Yeah.
In terms of balance of payments, yes, strong this year. Last year, $2.3 billion. This year, looking at around $2.4 billion. But somewhere in May, we were projecting around $2.9 billion in terms of your current account surplus because of your positive trade balance. But imports are recovering faster than we thought. So as those imports recover faster, it's going to erode your current account. It's going to erode into that balance we thought. So that's why we've lowered that. But I still expect that offshore investments will be strong, maybe not in the short term, but next year. I say why maybe not in the short term. When your offshore players are looking at investing, one of the things they look at are your real yields. So your real yields is where your nominal yields are minus the inflation rate.
Yeah.
If technically, especially for a local person, if I invest in a security and inflation is high, it's technically underwater. So your real yields is what they're looking at. Those have been eroded. But in terms of our outlook for inflation, we're actually a lot more aggressive in how we think inflation is going to move lower compared to what the central bank is looking at. Why? Because of that kwacha appreciation we saw. Also because of, numerically speaking, inflation has been elevated for a while, so the base for inflation has been increasing significantly. That's going to be now, in terms of between November and June, you're going to have this significant and large unwinding base effects of inflation, which are going to drive a larger drop in numerical inflation, which is why we think inflation can actually, in terms of our projection, be under 8% at the end of December next year.
Okay.
For me, just one final thing I'd like to close is with regards to your FX. So I mentioned a lot of things are positive on FX. But what's inhibitive at the moment is your FX structure. Remember previously you'd have your mining players coming into the market.
End of the month,
End of the month, middle of the month.
Tax season,
So the tax is predominantly middle of the month with regards to your pay as you earn. And then in the provisional tax months, your January, your April, your July and October, you have a lot more conversions. Those dollars now predominantly going into the central bank, and the FX market is significantly dependent on the central bank to actually sell dollars. It's got the potential to underpin speculative dollar purchases. Why? Because the only time that you really see the FX rate moving lower is when the central bank maybe aggressively sells dollars. But right now, in the manner in which they're transacting, they're only really selling dollars when there's pressure building. So unlike previously where a mine had to sell dollars middle of the month, regardless of what was happening.
So that they convert and pay taxes.
You don't see those pullbacks that would inhibit speculators. Now I think speculators have it easy on the FX market, and you can see it from the dollar deposits. Those increased from around $2.2 to $2.3 billion at the end of 2019 to as high as $3.1 billion in June. They're now at around $2.9 billion, but a large majority of that shift from kwacha deposits into dollar deposits has been speculative, and is something that needs to be addressed. But it's interesting because we're here on Money Watch. If you look at dollar purchases, holding onto the dollars for a year versus actually buying a one-year T-bill, I'll ask you a question, Yowela. Over the last 10 years, how many times or how many years do you think it has been more valuable to hold onto dollars for a year versus holding onto a one-year T-bill?
In terms of years,
the last 10 years, how many years has holding on to dollars beaten holding on to a one-year T-bill?
Not more than one, in my opinion.
Okay, close enough. It's actually 3 years.
Okay.
So it's actually very, very perplexing and interesting that people always think that holding onto the dollar
It's profitable.
is profitable.
It's not.
It's not. So now, if your one-year T-bill investment has beaten holding onto dollars 7 times out of the last 10 years, then what's the better investment?
T-bills.
It's a T-bill, and that's a one-year T-bill. Now imagine you're talking about a 2-year bond, a 3-year bond, a 4-year bond.
Yeah.
The way I think it's better to always speak to people on your money watch and your investment programs is to tell them that you compare the interest rate on the yield that you're receiving on the security with the depreciation. Okay? So right now, if we're saying a lot of things have improved fundamentally on the FX, and it's looking well for us, if the government moves forward with their progressive pro-business, you could see increased FDIs. You're also going to see increased foreign portfolio investments. You're going to see money coming through from the IMF, potential foreign capital from other multilateral lenders. Do you think your FX rate is going to depreciate, or the kwacha is going to be depreciated by over 22% over the next 5 years, every year?
No.
But what does a 5-year bond give you in terms of interest rate?
Gives a solid
22%.
solid yield, and you're sure of that.
Exactly, and you're getting a 5-year bond now pays you 22% in terms of interest rate per year over the next 5 years.
Yeah.
For you to hold on to dollars over the next 5 years, to actually beat that return, you're saying that you're expecting the kwacha to depreciate by 22% a year over the next 5 years.
Yeah. Which is also...
Which means that you're looking at a kwacha rate of above 100 in 5 years' time.
Well, on that note, Dean, thank you so much for coming. I think it's been insightful. We look forward to the next quarter.
Yeah.
I would say cautious optimism.
Yeah. Cautious optimism. Key events.
Yeah.
Budget. IMF. Debt restructuring. Is it going to be a portion?
Yeah.
Or the entirety? We've got that major maturity of the Eurobond, September 2022. We'd be hopeful that a significant amount of the restructuring is actually done before then.
Ah, fantastic.
Also important, understanding of the external debt and some of the contractual obligations there. Will they accelerate or actually inhibit a quicker restructuring process?
Fantastic. Thank you so much, Dean. Yeah. So that was Dean Onyambu, economist and FIC strategist at Standard Bank Group. Cautious optimism for Zambia's economic growth. But anyway, we also look forward to the upcoming budget speech by the Minister of Finance next month. That's it from me. See you next week.